Hi, this is Chris with Investors Underground. In this video, I'm going to talk a little bit about options trading and how you could potentially use puts or calls to express a view that you have on the underlying stock instead of going long or short the actual equity itself. There's pros and cons to using a strategy like this, and that's what I want to describe today in this video. So before we begin, I want to define what is an options contract. Both puts and calls are just types of options contracts. They give you the ability to either buy or sell a stock at a particular price over a particular time period. And that's it. A call option gives you the ability to buy a stock at a certain price over a certain defined time period. And we usually use call options to express a bullish view when we think that a stock is going to go up significantly. And conversely, we use put options to express a bearish view, or when we think a stock is going to go down significantly. In theory, if I am bullish on a stock and I purchase a call option and the stock goes up a lot, then that option should increase in value. And on the same hand, if I am bearish on a stock and I purchase a put option and the stock decreases enough, then I should make money on that put option as it increases in value. Calls and puts are just ways to express a directional view on a stock, instead of buying or shorting the underlying security. When I'm looking to potentially do an options trade, I need to look at three different things. The first thing is the stock itself. The underlying security needs to have enough range to make the trade worth it. If I'm buying a call or a put on something that barely has any range, it's not the right instrument to be trading options on. I want things that can either trend cleanly or they might do a sharp reversal. Both of those situations would give me enough range to make sure that the call or the put could potentially be profitable. The second thing that I'm looking at is the time frame for my trade thesis. Do I think that a stock is going to drop today, or is it going to take a week or a month for my thesis to play out? And then once I establish my trade time frame, I need to select the appropriate expiration for the options contract that I'm considering. It would not make sense to buy a weekly options contract on a stock that I think is going to take a month to make a significant move. I want to align the expiration date of the options contract with the view that I have on the stock. So if I think that a stock will make a significant move this week, then a weekly options contract could be appropriate. The third thing that I'm looking at is the price I have to pay for that options contract. The price that you pay for an options contract is known as the premium, just like you pay insurance premiums. So when I'm looking at the premiums for the options contracts that I'm considering, I need to make sure that they're low enough to allow my reward to be multiples of my risk. And what I mean by that is that if you pay too much for an options contract, even if the stock moves in the direction that you think it will move, you might not get any upside because you paid too much. So we need to make sure that we're paying an appropriate amount for the options premium or the options contract in order for us to be able to maximize our reward if we are right. So now I'm going to show you an example of a stock where you could have used a put option to make a nice trade on an underlying move. The stock that we're going to take a look at is AMD. I'll show you the stock chart, I'll show you the options chart, and then I'll show you the options chain. And we'll take what we've learned in this video and piece it together so that you can see how I could have traded or you could have traded this underlying move if the trade's set up. So this is the chart for AMD. I'm filming this on a Wednesday. The stock went from about 157 at the start of the day and it went all the way down to about 151 at the low. So that's a 6-point move, which is fairly significant and it has good range, especially if we're talking about options. So now that I've picked out a stock that I think could have a significant move down, now I want to go to the options chain to see which options are available. This is an options chain. It can look a little bit overwhelming, but it's actually quite simple. I'll give you a minute to look at the top headers of this so you can see what all the different columns are. You can see in the middle that we have the strike price, and that is simply the price that someone could either buy or sell the stock at based on which options contract they get. On the left-hand side of the options chain, you'll see the call options, and these are the available call options for this week's expiration, which with today being Wednesday is 2 days until Friday. So these are weekly options contracts, and that's what we're looking at. So on the left-hand side, you can see all the weekly calls, and on the right-hand side of the options chain, you can see all the weekly puts. And so these different columns can show you what is available to potentially trade on AMD for this week. So I'm looking at this options chain at the end of the day. So these prices reflect what the option price closed at. And you can see that in the column labeled last. That is the last price that these options traded at. So if I came in with a view that AMD was going to fall from roughly 157 down to 150 during the day, then I would be wanting to find a strike that is somewhere that is starting slightly out of the money and then could end up being potentially in the money. And so what that means is that if the stock is starting at 157, I would be looking at something like the 155s or potentially the 152.5 strikes. And that would mean that as the stock decreases, that those put options on the right-hand side of the options chain would be gaining in value. So just like you can chart a stock, you can also chart an option. And this just shows the change in the value of the option throughout the day. So you can see at the lower left-hand side of the screen, the 152.5 strike put option for AMD for this week's expiration started the day at about $1. It then started to fluctuate between about $1 and $1.50. Anywhere in that range would have been an appropriate price to pay if I think that AMD was going to fall from 157 down to about 150 or so, because that would be a significant enough move for this option to increase in value as it went from being out of the money to being at the money and then being in the money. And so we can see that the price went from about $1 or $1.50 all the way up to about $3.40 at the peak of the day. Now, when I'm looking for options that I want to potentially trade, I want at least a 3-to-1 reward to risk. And so what that means is that I need to be able to estimate that the option that I'm considering can roughly triple, if not quadruple or more. The higher the potential, the better. So this option started trading at about $1 or $1.50, and that could have been a reasonable purchase price if I think that the stock can have a significant move down, which would then bring the value of this put option significantly up. And so if I were to buy this put option at the start of the day and then scale out or sell it into the strength, then I could have either had 2 or 3 times my money if the trade were successful. And this is an example of taking an underlying security that you think can have a significant move like AMD, and then looking at the options chain and selecting the right strike price for the put option that I'm eyeing. And then thirdly, I need to make sure that the option price that I'm paying or the option premium that I'm paying is small enough that if the trade works, I get a good amount of reward, at least 3-to-1. And so piecing those 3 things together, we can see how buying a 152.5 strike put option for this week's expiration would have been a very good way to play the move down in AMD this week. Now that I've shown a successful example of a put option trade working out with AMD, I need to talk about what would have happened if the trade went wrong. So if AMD started to go up instead of starting to go down, then the put option would have lost value rapidly. Now, the benefit of just buying puts or calls is that your risk is capped at the amount of money that you put in. So if you put in $500 or $1,000 into a put or a call option, that's the most that you can lose if it all goes wrong. Now, you can still use stop losses on options, but because they move so fast, you usually need to use a wider stop than you do with equity. And so you might be able to set a 5% stop loss on an equity position, but you might use a 20 or 30% stop loss with an options position, depending on the time frame. So what I tend to do with options trading is I use significantly less money when I'm trading options than I do when I'm trading equity. So if someone typically uses $10,000 for an equity position and they can risk $500, what they might consider doing for an options trade is only putting in that $500 that they are willing to risk. That way, if the trade starts to go bad, you can get out and maybe get half or 60% of your money back. But even if everything goes wrong, you're still okay with the risk because you knew that the money that you put in was at risk of going to zero if everything went wrong. And that's really how I approach things with options trading. So I hope that this video has been helpful for you to better understand how someone could use call or put options to express their view on a trade. We talked about the 3 things that I really pay attention to when I'm considering doing an options trade. 1, the range of the underlying security. 2nd, the time frame for my trade thesis. And 3rd, the price that I'm paying for the option. If these 3 factors line up in a positive way, then I potentially have a trade that I can take. Thank you for watching, and I hope that you consider joining Investors Underground, where you have some of the most experienced traders in the business working together and sharing strategies to help you trade to the best of your ability. Thank you.